Hello and welcome to this panel on transforming the global financial network to reach net zero. My name is Lutfi Siddiqui and I'm with the London School of Economics and the National University of Singapore. We have about 40 minutes or so to hear from my distinguished panel, representing different nodes, significant nodes in the global financial network. We'll try and cover as many perspectives as possible. The perspectives of knowledge providers and bridge builders, asset owners, asset managers, corporate financiers, risk managers, and regulatory governors. We're all agreed here on the goal of net zero. We're also agreed, I think, on the need to mobilize private capital. We're also agreed that the pledges made in recent months from hundreds of firms across many different countries, if followed through, has the potential to take us towards net zero. So we're here to talk about how we can get there, practically speaking. How does the global financial network need to be transformed in order for it to be better mobilized? So let's get straight into it, starting with Rhian Marie Thomas, Chief Executive of Green Finance Institute, which is backed by the UK government and the City of London Corporation. She's an emeritus member of the Task Force on Climate-Related Financial Disclosures, TCFD, and she's co-chaired the launch of the Task Force on Nature-Related Financial Disclosures, TNFD. Rhian, welcome. An easy question for you. How do we build on these commitments? Everyone's made promises. How do we build on those commitments to mobilize capital?
Well, thank you, and delighted to be part of the panel discussion today. It's become a bit of a truism in the environmental financial community that, there's trillions of investments that were needed to transition to net zero can't be met from the public purse. And so we need to mobilize private capital at pace and scale. And we seem to be seeing a lot of commitment and rhetoric on this. And now we really do need to move towards implementation. But the reality is that within our current financial system, for private money to move, it needs to make money. And that means green transactions making comparable risk-adjusted returns to the existing opportunities for lending and investment. And importantly, from the borrower's perspective, the cost of capital of the financing on offer that needs to be competitive with existing sources of funding. And if those criteria aren't met, then the status quo mostly prevails, despite the scientific imperative to act on the threat of climate breakdown. So to answer your question, and we look at what are the tools that are available to sort of increase the incentives for mainstream private capital providers to redeploy capital towards transition investment. And they all include collaborative efforts between industry sectors, finance providers, policymakers, and the regulators. So I'm going to start by saying I think possibly the most effective solution would be introducing a progressive carbon price across industry, so effectively changing the price of everything in the economy and influencing consumers' choices and behavior. But we then know that there are real challenges if, in the absence of global cooperation, inevitably some countries would need to take the lead, and that potentially puts their domestic industries and economies at a competitive disadvantage. So a very live discussion and one that would merit a panel all of its own. But so I'll leave that there. But other levers include giving banks capital relief for their green lending by applying a discount to the risk weights that they apply to green loans. Again, that's been discussed for a while. Banks could then fund those loans with less loss-absorbing equity than they currently do, and they would need to do otherwise. I'm conscious that I'm very much straying into Chris's area of expertise, but there is some evidence from analogous interventions in the SME market, for example, that a green supporting factor, as it's called, would have to be really large to have any impact. And if it were really large, then it would allow banks to increase their leverage, which would hurt financial stability. So the green supporting factor idea potentially pits two legitimate public interest objectives against each other. So greener finance on the one hand, safer banks on the other. So a far better solution would be to raise risk weights for non-green assets, which would strengthen banks and discourage lending for fossil fuel activities. Again, a topic that we could go into at length. But for a more transactional solution, which is very much to use public finance as effectively as possible to create investment opportunities for finance, for private finance, commercial finance. Again, not a new idea. Finance flows that blend public and private finance have totaled just over $160 billion over the past decade. Sounds like a lot, but is a far, far cry from the trillions that's needed. But what's changed, which I think adds particular impetus to this solution, is what you mentioned up front, which is we have this unprecedented opportunity to scale up these types of transactions because we now have 450 plus financial institutions that have signed up to achieve net zero under the Glasgow Financial Agreement for Net Zero, or GFANZ. And so we have this unprecedented opportunity to deploy public philanthropic capital as concessionary investment to not only provide technical assistance and capacity building, but also to de-risk transactions to enable that private capital to move into unfamiliar jurisdictions or unproven technologies or business models. So now we really do need an equivalent commitment from public finance sources to support that increased mobilization of private finance through increasing their focus on providing de-risking mechanisms like guarantees, in particular, so first loss tranches, for example, contracts for difference, revenue support guarantees, all in relation to tackling the chronic underinvestment in transition and adaptation, particularly in emerging markets. So there's an opportunity to work with the overseas development aid budgets, the multilateral development banks, and the development finance institutions to shift the current emphasis away from originating and holding risk towards originating and sharing risk. I'm conscious that turned into more of a diatribe than I was expecting, so I will leave it there, but happy to come back on any of those points later.
Thank you so much, Shreya, and I think that really maps the system. This is a complex system that needs to be transformed and mobilized and directed, so that sets the scene for us. I have a few questions that I'd like to follow up on, but let me come back to you. Let's move on to our next panelist, Ziad Hindo. Ziad is Chief Investment Officer of Ontario Teachers Pension Plan. He has overall responsibility for the global investment portfolio and strategy, including the real estate portfolio. With great responsibility comes great power. So Ziad has been instrumental in establishing a comprehensive climate strategy anchored by a commitment to achieve net zero by 2050. Ziad, welcome, and also an easy one for you. Have you divested from all high-emitting companies yet?
Thank you, Lutfi, and very happy to be on this panel. First, let me start by saying we do not believe in divesting. We believe that it's just passing it from one hand to another without really having real-world positive impact of reducing emissions. So as a direct, active, engaged investors, we believe we are determined to bring our capabilities, our capital, our talent, our established global partnerships to make a real impact and accelerating that transition to net zero. So if I could talk a little bit about investment strategy to bring it to life, to make sure that folks see it as being very much multifaceted. We announced our commitment to net zero by 2050. We follow that with announcing our interim targets to reduce portfolio carbon emission by 45% by 2025 and 2/3 or 67% by 2030. These are, at least in our industry, quite leading in terms of their ambitions. And we believe we can get there in a number of ways. First, investing directly in green assets. So we just set ourselves a target of increasing our green assets exposure from 33 billion to 50 billion. To put that in context, our overall AUM is at 242 billion. And those are, the typical green assets you'd be familiar with, renewables. So I always like to give live examples to bring it a little bit in terms of its livelihood. For instance, Corio Generation, which is a renewable platform that we partner with Macquarie on. It's an offshore wind platform. It's a global platform. That's one example of renewable asset. We invested in Green Collar, which is the leading environmental and carbon credit platform in Australia that we're very, very excited about. Another very different example is Fulcrum Energy, which is a sustainable fuel business out of California that turn municipality waste into sustainable fuel. So hopefully that gives you perspective, but the range of green asset investing that we do and we're very much committed to. Second, on the question of divesting, we actually just announced that we're going to initially commit $5 billion to invest in what we call high carbon transition assets. And these are high emitting companies, but they need capital, they need patience, they need partners to make sure they can transition themselves to net zero. So they need pragmatic owners to shepherd and see that journey through. And we're very excited about that. We believe this will be an important part of our portfolio. It will be measured separately. We want to be very transparent about it. We want to be transparent about the robust plan we put in place to make sure we are actually decarbonizing those businesses and report to them. And that will hopefully demonstrate not only the progress we're making, but we be clearly holding ourselves accountable. This is vastly superior to divesting because it actually leads to real positive world impact of reducing emissions rather than just passing it to somebody else to solve this problem. We also have investments in private holdings, more than 150 portfolio companies, and we're committed to work with them to reduce their own emissions. So again, we have another target by 2030. We want 90% of the emissions that come from companies where we have significant stakes in to be on path on a credible net zero plan. So we're working closely through more than the 300 board seats that we have on these portfolio companies and through our decarbonization playbook to assist those companies in finding a way forward to net zero by 2050. The other important aspect of our strategy is global partnership, and this is absolutely critical. So we want to find partners that share our ambition for climate transition, but also partners that we can learn new insights from that we could bring internally back to teachers. And two great examples here would be our strategic partnership with Brookfield. So we are an anchor investor in the Global Transition Fund at $15 billion fund. This is one of the largest private pool of capital that will address climate transition. And on the private equity side, we're strategic investors in TPG Rise Climate, also one of the preeminent investors on the impact investing side. Fund and a couple other things I would say. We issue green bonds, absolutely critical to fund our green assets, and they've been very well received in the marketplace. And then through our influence, we really want to change the debate, change the conversation, so we can collectively, in a collaborative way, just like Rian said, find solutions together to solve this problem, either through the board seats that we have or through proxy voting, and through continuous dialogue with regulators, government officials, policymakers around the world. And in a short period of time, happy to say that we've already dropped our portfolio carbon emission by 32% from the baseline in 2019. And our portfolio companies, the number of companies that are reporting emissions since 2019 has gone up from 37% to 80%. So very pleased with the progress we're making. Over to you. Thanks.
Thank you very much, Ziad. And sounds like a very clear theory of change. You're very clear about how you're going to use your power of influence across the various touch points that you have in the financial services network. Next up, I'd like to move to Zoe Knight. Zoe is Group Head of the HSBC Centre of Sustainable Finance, amongst several leadership roles across the climate change network. She sits on the WEF Global Future Council on net zero transition. Zoe, welcome to you. What, from your point of view, are the most significant challenges that you're facing in supporting or not supporting the planet's transition to net zero?
Thank you. And just to echo my fellow panelists, thank you for the invitation to join you today. It's certainly an interesting discussion and a timely one. And second off, just to echo the points on investment, not divestment. So HSBC has also set some targets around how we'll facilitate the transition. We want to be a net zero bank by 2050, and that's our ambition. But we realise that we need to move a lot faster than that. And so to that end, we're setting shorter term targets around both our operational emissions and our financed emissions. And going back to this maximum impact point, we'll have maximum impact if we can transform the underlying economy in the societies and countries that we serve, which reach some 63. So our global footprint can have a sizable influence on the energy system and the stakeholders in those countries. So we've set these financed emissions targets covering the power utilities and oil and gas sectors. And throughout the rest of the course of this year, we'll be completing that analysis for a wider range of industrial and transport sectors. And that leads me really onto the biggest challenges that we face. So there are a number, and one of the challenges is the internal improvements that banks need to make into their processes and collective problems across the entire market. So the first critical challenge is data. And through the support of the industry as a whole, data is improving, as Ziad just pointed out. You know, that massive uptaking disclosure is really mission critical in terms of how we can assess whether clients and customers and governments are moving forward on their net zero transition plans. So this may, in some places, require mandatory disclosure. It may require regulators to intervene. So, for example, across the Middle East, the region that I'm working in now, and Asia, the transparency and the disclosure levels are maybe not where they need to be for us to make detailed transition assessment of what our clients think and how governments are positioned. So this is about linking the climate plans that countries are submitting to the UN as part of the COP process into both investment roadmaps and tangible activities that demonstrate those plans are being implemented on the ground. And we can really help with our stakeholders in driving that forward, whether it's through national dialogue with them, so the national climate dialogues, or whether it's in partnerships with other investors, other financial coalitions, or other think tanks to drive that forward. The second challenge really is policy, and Rhian-Marie alluded to this around capital treatment. If capital treatment is more aligned for the transition, then we need a more supportive policy environment, and that will reduce investment risk, and it will mobilize capital flows. So the reality around emerging and development market starting points, i.e. the differences in energy grid makeup, the differences in development context, etc., are a really big issue to drive this agenda forward. Now, there are positive policy frameworks in place, but they tend to be fragmented. You know, we'd like to see more on consistent and standardized approaches. That's not to say that there's a one size fits all in this space, but it is to say that we do want to all be heading in the same direction of travel to facilitate that net zero emissions outcome as fast as possible. And that's where we see our role really is coming together here. We can play a massive influence in speeding things up, right? We don't want to be net zero by 2050. We want to be much sooner than that. And one of the things that we hear quite a lot is, oh, I can't really move any faster than my government's net zero goal in terms of the year that it's set out for, or I can't really move faster because the policy environment doesn't quite look right. Well, those points are factually correct, but actually, if we can just use our influences across the financial system to unlock those levers, we can really bring the data of net zero forward, and we can really have an influence in building best practice across markets and bridging between industries and fostering the radical collaboration that we need to see. So, you know, we're quite optimistic in terms of our strategy going forward and how we can really help things to move a bit faster.
Thank you, Zoe. We hear it. We hear quite a bit about the need for regulatory interventions around definitions, data, disclosures. So it's probably a very good time to bring in Chris Faint. Everything rests on his shoulders. Chris is head of the climate division at Bank of England, responsible for the regulatory authority's strategic approach to climate change, providing guidance on how their supervisory firms should address the financial risks arising from climate change. Chris, welcome to you too. And what have we learned from the Bank of England's recent scenario analysis exercise, particularly in terms of what does it tell us about the system's progress made or otherwise towards net zero?
Great. Well, thank you for having me here today. Yeah, well, the CBES climate scenario exercise has taught us a huge amount about the transition. But before I go into some specifics, maybe if I just take a couple of steps back, because I thought it might be useful to provide a slightly different perspective from those that we've heard, which is about the risks. It's about how we should think about risks as we move through the transition and how that should shape the actions that we take. And I say this from the perspective of a central banker, where we are heavily invested in the greening of the market. And the key role that we have to play in this space is ensuring that the risks are managed and they're priced in. And I can maybe come back later to the points that have been made about penalising factors and supporting factors. But as we do our work, our starting position is that, of course, it's essential that we fund the transition and move away from more polluting sectors. If we don't, the physical risks will be pervasive. To do this, some commentators are agitating for a sudden removal of capital or investment from more polluting sectors and the instant rechanneling of that into green activities. But we caution against this, and I think we've already heard some of the some of those that agree with it, that defunding certain sectors too quickly at a point where substitutes are not available could create a disorderly transition and a potential shock to the system. And this is something that was shown in our recent CBES scenario exercise in some detail. And what we did in that exercise, we asked banks and insurers to model how they would react against a number of different 30-year scenarios. And one of the key findings was that in those scenarios, as transition goes through, they would look to pull money out of those sectors that they expect to be subject to the greatest transition risks. And you can even see that in an orderly transition scenario. So that's a transition scenario where you start transitioning today, it's relatively ordered. And within banks, the level of lending to mining and quarrying firms falls by over 40%. Within life insurers, the equity investments in firms that extract petroleum and oil lose 70% of their value. So what does that tell us? Well, it suggests that these firms are not baking in an expectation of material transition within these sectors. And in the absence of clarity over what's going to happen in those sectors, they are pricing in obsolescence and assuming that there's not going to be a transition. Now, there's a rationale for this. Of course, you're going to price in risks if you don't have clarity over what's going to happen. And the decisions could be driven by risk. It could be a result of external pressures, or it could be a result of needing to meet targets. But the risk is that each of these decisions makes sense in isolation based upon each institution's internal deliberations. But at the system level, when you add them all up, it could give rise to sudden cliff edges in terms of funding, and that in turn could give way to shocks in the system. So, but as we see it, when we look at the financial system, as we look at the movement to net zero, which is 2050 in the UK, but has different times in different countries, we're increasingly focused on what needs to be put in place to allow firms to make investment decisions through a whole economy lens and information that allows them to evolve the lending at a fast enough speed to facilitate the transition, but not in a way that is too fast or disorderly that creates additional risks. And the kind of things that we are looking at to help that process, to help firms as they make their investment decisions, is, well, the first one, in an ideal world, we would have government policy clarity for the whole period of transition. But as we've seen with recent energy price shocks, pragmatically, there's going to be significant barriers to being able to provide clarity on what that transition looks like for the short term. So it's unlikely we're going to get that clarity for a while. In the absence of that, what we should do is we should build up market practices that allow us to build up an understanding of how firms are thinking about the transition in the real economy and then in the financial system. So that requires things such as transition plans, additional disclosure, which allows institutions to understand at what speed firms will be transitioning and how that can in turn affect the funding that they provide to those firms, with transition caveats or whatever the appropriate funding schemes are. And also, the development of tools that allow clarity over what investments might look like. So the FCA in the UK is looking at developing green labels that will provide indications to investors of how green something is, and hopefully in the future how green something might be, to allow us to transition those areas that are grey at the moment. So I guess my key point is that as we think about the whole ecosystem, as we think about the movement towards net zero, we just need to keep one eye to the fact that we need to have the right speed and be making the right decisions from a whole economy perspective. And that is going to take some heavy lifting, because we don't always have the lenses to be able to do that. Although we are seeing some encouraging movements that will allow us to do it in a slightly more informed way in the near future. Thank you.
Thank you, Chris. So I guess my follow-up question to you would be about that particular point about changing of risk weights and how to do that in a measured manner. Let me come to where we started with Rian. Rian, so having listened to particularly the bank and the asset manager, are you encouraged? Do you feel that they have been able to address the basic truism that the private sector needs to make money? Or to flip it around, and in the way Chris put it, they need to certainly not lose money. Between those two, is there enough there to get us on the path at the speed that we need to progress?
We work at the Green Finance Institute. We work very closely with both, as well as with the regulators and the policymakers. We work very closely with the banks and the asset managers. So very familiar with the points and indeed the work that Zoe and Zayed mentioned. And we have reason to be optimistic. We are certainly seeing a lot of progress, and in particular hats off to the work that HSBC has been doing around their fast infra labels, for example, which is a great example of private, public, NGOs all collaborating together to address a genuine problem. But if we go back to the point about requiring concessionary finance, be that philanthropic or public money, to help de-risk situations that will enable more private finance to flow more quickly, some of the challenges that we see are things like, according to convergence data, 62% of blended finance transactions, or 62% of organizations that participate in blended finance transactions, they do it on a one-off basis. So these are completely bespoke transactions that are not apparently replicable. And if something isn't replicable, it's very difficult for it to be scalable. And going back to this point about transactions needing to make money, it's not only the yield that's important, but it's the transaction costs. It's the friction costs of how long it takes to innovate new financial solutions that can potentially take quite a long time. And I'm talking years in some cases to put some of these transactions together when it involves development finance and public balance sheet. And so going back to Zoe's point about, one size can't fit all for these things, but there is a requirement for more standardization, for example, around guarantees, so that we can actually we can actually draw down on these types of instruments and we can actually replicate them with greater ease. And I genuinely think now is the time for us to be really doubling down on this effort and using the structuring and the expertise that sit within mainstream financial organizations to support public finance in partnering.
That's a great point. So the ability to have some sort of master templates, Lego blocks to mix and match, so you can structure, in the way that subprime was fairly easily structured into CLO and CDO tranches, where the senior tranche was de-risked by the junior tranches. So things like that perhaps can be put to good use. Zayed, how do you communicate to manage the challenge of communicating with your stakeholders? Because you have a very clear theory of change. It's a non-linear, sophisticated theory of change. It's not just, we'll do if then else statement. How do you manage the challenge of communicating with your vast and multiple stakeholders?
Yeah, good point, Lutfi. We do have clearly, as investors in more than 50 countries, we have a large set of stakeholders that we need to manage. And I think it is about communication. We need to be transparent about our activity. We need to communicate clearly how we're articulating the intentionality of our capital allocation decisions. That is specifically important when it comes to deploying capital and decarbonizing high emitting assets. Because we know there's a lot of debate out there in terms of do you invest, do you divest, and so forth. So we need to be upfront and transparent about disclosure, about the progress we're making. And I think through hopefully the many wins we will have over the years, we can convince stakeholders that are doubtful about the effectiveness of this strategy, that we can start winning minds and hearts of people. But we believe by committing to decarbonizing those high emitting businesses, we're absolutely doing the right thing. And by the way, the one reaction I probably have to Rian's point, this is not about concessionary returns. We actually believe we can do both. We can generate the returns as fiduciary that pay our pensions, but also generate positive real world impact. Those two do not need to be inconsistent with each other. There's a lot of private capital out there, and I think that capital can absolutely be put in good purpose to solve those real world problems.
If I may just come back on that, I'm not suggesting for a moment that private capital should start taking concessionary returns. In fact, I'm saying exactly the opposite, which is that finance that is already deployed in a concessionary way, so development money or philanthropic money, could be put to even more effective use if it was used specifically to try and de-risk solutions. So first loss guarantees or revenue guarantees, or if we've seen in the UK used to great effect contracts for differences, that actually provide more revenue certainty for private finance, enabling them to go into unfamiliar transactions, which currently today don't meet their risk return criteria. So I'm hoping we're in agreement on that.
Sure, totally support of that approach. Thank you.
I was hoping it would be more a disagreement, but okay, I'll take that. Would you agree, though, Ziad and Rian, or whoever wants to take it, that there is a trust problem? There is a trust deficit. People may not know or want to know how to differentiate between taking things at the right pace so that you don't create cardiac arrest in the real economy by withdrawing in one go, versus, to use a technical term, organizations taking the not really making a material impact and saying, look, we're engaging, it'll take time, etc., etc. How do you balance the two in an environment of low trust?
Shall I jump in with this one a little bit, actually? So there are two elements, right? There's the trust that the plan that's set out is going to be delivered, and the ability to be able to monitor that progress. But there's also the trust that the plan is actually going to add up to a net zero outcome at the end of the day. And that's the difficult point, because you don't often, for the most part, we know how to reduce emissions. Like, we know that that's what we need to do fast. But for industry and for the energy sector in certain locations, the decisions, the trade-off in decision of provision, cost, access, security, underlying economic backdrop, contribution to tax revenues, geopolitical positioning on trade flows, all of those factors are complex trade-offs. And so by having a what does good look like for those sectors discussion against the backdrop of knowledge gaps and differences of opinion on what a good pathway looks like, leads to that trust deficit and leads to the difficulty in backing the right way forward, as it were. And that's why the power of coalition and the power of thought leadership and the likes of the GFI is doing is mission critical for us to get there faster, because without a dialogue on these issues, we're not going to be able to solve the what is the best pathway for all of these different parts of the economy at the fastest rate possible to be able to get to that net zero outcome.
Great. Thank you. Thank you for that, Zoe. Chris, you used, I'm sorry, did somebody want to jump in?
I was just very quickly going to say, as well as framing the challenge as one of trust, which I agree is incredibly important, I think it's also an issue of familiarity, and that people genuinely are more comfortable doing transactions and business that they're familiar with than things that are new and unfamiliar. And so a lot of this just boils down to individual behaviors that aren't coming from a cynical place. They're just coming from a place of maybe of some fear of doing things that aren't familiar and the consequences of doing that. But otherwise, the points on trust, I think Zoe covered very well.
Ziad?
No, just saying trust also when it comes to private capital investing, you need a high level of certainty around regulations because you want to be able to understand the rules of a game. Those rules of a game can't change halfway through after you've committed capital. So when you give private investors the confidence that governments and regulators are backing them in helping that transition, then hopefully the amount of capital that is available, that is deployed to solve this problem, will start going up in a meaningful and material way.
Thank you. Chris, you mentioned orderly versus disorderly, or the lack of coordination perhaps internationally on some of these regulations. I've had investors say to me that, look, we don't want to be stuck in inadvertent greenwashing, so put money in good faith into something today, according to today's definitions and standards, and then next year they're deemed not to have been compliant with new standards. So can we get accelerated convergence and clarity on this in the way that, for example, we had with Basel III bank capital after the global financial crisis? So what's holding us back when it comes to coordinating and trying to get to an orderly regulatory pathway so that the private sector pathway can dovetail that?
Thank you. I don't think I agree with that. I think actually there has been a lot of coordination internationally in this space. And actually, I don't think it's a lack of potential coordination that's driving a disorderly climate transition scenario. What's driving would drive a disorderly scenario is one where we don't have clarity over what the pathway might look like, and as a result, decisions can't be made. What we're doing internationally, and by internationally I mean the group, there's a group in Basel that's working to look at this. There's groups at the FSB, the Financial Stability Board, to look at this. What they're looking to do is build infrastructure that will allow us to understand the risks, shine a light on the risks, and allow everybody to understand how decisions are being made. Now, there's a limit to what can be done with regulation in the absence of clarity over what the transition will look like. And the important thing, I think, in those scenarios is for us to think about what different pathways of policy options might look like. And that's one of the reasons why there's been a concerted effort in the international community to come together to come up with a set of climate scenarios that can be used to actually test us on this. And the NGFS is a group of international central banks that have come together, have over the last 3 years developed a suite of free to download, readily available scenarios that allow any institution to look at how different climate pathways might impact their business, and allows them to then think about what their strategy might be. So as I look at the developments over the last 3 years in the international regulatory space, I think it's relatively unprecedented for there to have been so much movement so quickly. Now, does more need to be done? Absolutely. Are there spaces where we can coordinate further? Absolutely, especially on things like scenario analyses, where each institution is doing something slightly different. But I don't think we're moving too slowly, especially best precedent in the past.
Okay, thank you for that. So we're coming towards the end of our time. One quick rapid fire round, if anyone wants to comment on this. How are you feeling in terms of progress made between COP26 and COP27 now that we're on the eve of COP27? If if it was 5 out of 10 this time last year, where do you think we are? What would be your individual scores? Let me start with Rian.
I'm going to hold out because the nature of these COPs is that everything seems to come together at the very, very last minute. We saw that in Glasgow, and we can only hope that that's what we're going to see in Sharm el-Sheikh as well. So I'm giving the politician's answer of hoping that my score will increase over the coming weeks.
Okay. Ziad?
I do have a concern that given the current economic and geopolitical challenges we're facing, that that climate will take a backseat again. So personally, I would say I'd like to see a more concerted effort. I'd like to see some of those pledges come faster in terms of execution and implementation. Thanks.
Zoe?
So I'm seeing a lot of really hard work going on by the presidency to try and bring to life some real implementation progress of the pledges that have been made. So I'm optimistic that we'll see a little bit more of a tangible outcome in industry and energy as we get to COP27.
Thank you. Chris?
And I'll also not provide a mark out of 10, but what I will observe is that with COP being held in Egypt, I think it's really fantastic that there's going to be a focus on those countries who've got more of emerging economies. It's really important in the same way that you need a whole economy transition within the UK, you need a whole economy transition across the world. So drawing out those particular challenges that all types of economies have, and then looking at how we can address those in a very short period of time, I think will be really important. So I'm looking forward to seeing where the presidency comes out in that regard.
Great. Well, thank you very much. Thank you to all of you. We've come to the end of our time. I just want to say that I'm feeling a lot more positive and optimistic just at the end of this these 45 minutes. I was expecting you all to be sort of more tentative and more, reading off of corporate comm scripts, but I think you're all leaders, you're drivers, and so this is extremely encouraging, and thank you very much for that. And so to the audience, I guess we're moving on to the next session, so please stay tuned.